back. It was a blowout jobs report from May. The U.S. added 272,000 jobs. That was well ahead of the 190,000 consensus. Meanwhile, the unemployment rate did rise to 4%. So did this jobs report throw cold water on hopes of a summer rate cut? Well, joining us now is Jeremy Siegel, professor at Wharton School. Professor, it's great to have you on this show, and that is very much where I wanted to start because the headline number was very strong, the wages data was very strong, but we did see unemployment tick higher, and there were some signs of, I'll call it bifurcation, when you looked under the hood in this report. Is the thesis around the Fed not cutting and holding steady through the summer still intact?
Well, Morgan, one thing that I think is noteworthy about today's action is how many times have we seen the 10-year go up 12 basis points, which is quite a big rise, and stocks held their own. Normally, that bigger rise would really depress stocks. I think it was sort of a relief. You have to remember that we were getting some very weak data late last week and early this week. It looked like the economy was sliding. In fact, the Atlanta GDP now was below 2%. At the beginning of the quarter, they had actually thought the second quarter was going to be over 4%. So there was some fear, oh my goodness, we're slipping, could be into recession. I think with this employment report and the ISM report that we got a couple days ago, there's a sort of a sigh of relief. And actually, I saw that Atlanta now is actually above 3% again for their estimate of this quarter. So what we have is the economy is holding in. You're right, it's mixed. Household was down. The establishment survey was up. There was a little, I think one of the reasons yields rose, and this addresses your question about what the Fed is going to do, the wages were hotter than expected. But we have to remember that there's an important wedge between wages and inflation, and that's productivity growth. So we can't just translate, this wage means this inflation, because if productivity moves upward, and we did not have good productivity in the first quarter, but oftentimes it bounces back. This 4%, 4.1% wage growth is not at all threatening for inflation. And I actually think we're going to get good inflation news in the second half of this year.
It's interesting to hear you talk about the productivity wedge there, because what's new and what's different about this cycle, arguably, is the implementation of AI. We don't always talk about it from a macro or economic standpoint, but I wonder if that is factoring in here, particularly when you do put forward a thesis about, say, a soft landing.
Yeah, absolutely. I mean, I believe that AI is going to be very important for economic growth. Now, a lot of economists are saying, is it yet? A lot of people are talking about more 2025, 2026. Goldman Sachs and others say that it could increase real GDP growth between 75 and 150 basis points for up to a decade. I mean, that's huge growth going forward. So it is certainly probably, I think only about 8 or 9% of firms have really implemented AI programs yet, but we're on that cusp. And don't forget stocks. Stocks are a forward-looking asset. The market's forward-looking. So even though the productivity might be trickling in slowly now, I think there's encouragement about what's going to happen in the coming years.
Okay, so even as yields have ticked higher, at least in trading today, can stocks continue to move higher as well?
Oh, yeah. I mean, we're still, we had gone down 30 basis points. We kind of took a third of that away. And again, when we talk about yields going down, people say, that's good for stocks. Well, there's two types of yields going down. If it's because of a weakness in the economy, that's not good for stocks. If it's because of slowing inflation, that's great for stocks. So as we all know, the Fed next week, it's it's going to be a very fascinating week because we know the CPI comes on the day that Fed is going to give their announcement on Wednesday. I believe that Chairman Powell will have that data actually on Tuesday afternoon and can incorporate it in that. But I'm expecting, as many other economists are, that the data is going to get much better in the second half, particularly because we know that the housing statistics that the Fed uses and government are lagged, and that housing prices have not, and rental prices are not going up now at the rate that they report. Insurance rates are stabilizing. Those should appear in the second half of this year and bring inflation down much closer to the Fed target.